This is the first part of 5 videos that cover cost, volume, profit for Accounting 311. On this slide, I start off with the basic profit model. Let's let pi equals profit, and profit is equal to revenues, which is price times quantity, minus variable cost, which is the variable cost per unit times quantity, minus the total amount of fixed cost. Notice that I make no distinction between period costs and product costs here. All I care about is whether a cost is a variable cost or a fixed cost. On this slide, we do a little simplification of the model in that we collect terms and we end up with price minus variable cost, which is what is normally called the contribution margin. So the final formula that we will often work with is that profit equals contribution margin per unit times quantity minus fixed cost. Now, starting with the profit model, if profit equals 0, then we have a break-even condition. On the other hand, if profit is greater than 0, then we have a target profit condition. Using these conditions, we can see that if we wanted to know the number of quantities that will satisfy the condition, we set profit equals to contribution margin times quantity minus fixed cost, and then we solve for quantity. And this is the general formula we get both for the break-even formula and the target profit formula. If we want to add taxes in, we have to make a distinction between the after-tax profit and the before-tax profit. Normally, when a company sets a target, they're going to set a target in terms of after taxes. So the after-tax amount is equal to the before-tax amount 1 minus the tax rate. That's because you have to gross up the before-tax profit in order to pay taxes. So the before-tax profit is equal to the profit after tax divided by 1 minus the tax rate. So remember, target profit is normally after tax, but our formula didn't really take taxes into account, so it's before tax. But if we substitute in the relationship from up here, we can easily see that the revised version of the profit equation is profit after tax divided by 1 minus the tax rate equals contribution margin times quantity minus fixed cost. And we can use this to solve for Q. So in this slide, I've solved for Q, and you see that we get profit after tax divided by 1 minus the tax rate. We get that number. Then you add the fixed cost to it, divide by the contribution margin per unit, and you should be good to go. So in this slide, we have a quick review of the various formulas. First is the break-even formula. Quantity equals fixed cost divided by contribution margin. If we have a target profit but no taxes, then the quantity is equal to the profit, the target profit, plus fixed cost divided by the contribution margin. And if we have a world with income taxes, then the quantity is the profit divided by 1 minus the tax rate plus the fixed cost divided by the contribution margin. So here are a couple of problems that you should use the formulas to see if you come up with an answer. You should stop the video at this point and work them out. On the next slide, I'll show you the solution. Here are the solutions for the first 2 problems. We have a fixed cost of $1,000, a price of $10 per unit, variable cost of $6 per unit, target profit of $200. So the formula is profit, 200, plus fixed cost, 1,000, divided by the contribution margin. And the contribution margin is the price minus the variable cost. So this is going to be equal to 4. And if you do the math, it turns out that 300 units will generate a profit of $200, assuming no taxes. If the tax rate is equal to 20%, then we have to make an adjustment. And the adjustment is we take the after-tax profit, divide by 1 minus the tax rate, but otherwise everything is the same. So now we get $250 plus 1,000 divided by the contribution margin equal to 4, and it turns out that we need 312.5 units, so we could round that to 313 units.